Another day, another story. In the complex and dynamic world of finance, risk management plays a crucial role in safeguarding the stability and resilience of financial institutions and markets. Identifying, assessing, and managing various types of financial risks, including market risk, credit risk, and operational risk, is vital for maintaining sustainable growth and ensuring the long-term success of organizations. This video provides an overview of these risks and explores the key strategies employed in risk management. Market risk refers to the potential losses arising from adverse changes in market conditions, such as fluctuations in prices, interest rates, or exchange rates. This type of risk impacts both financial instruments held in a portfolio and the overall market value of an institution. To manage market risk effectively, organizations employ a range of techniques, including portfolio diversification. Spreading investments across different asset classes and geographic regions helps reduce exposure to specific market movements. Hedging. Employing derivative instruments like options, futures, or swaps to offset potential losses resulting from adverse price movements. Stress testing. Simulating extreme market scenarios to evaluate the impact on portfolios and ensure resilience against adverse conditions. Credit risk arises from the potential failure of a borrower to meet their financial obligations, leading to default or delayed payments. It affects lenders, such as banks or financial institutions, and is typically managed through credit assessment, conducting thorough due diligence on borrowers' creditworthiness, including analyzing financial statements, credit history, and industry-specific factors. Risk rating. Assigning risk ratings or scores to borrowers based on their creditworthiness, which helps determine appropriate interest rates, collateral requirements, or lending limits. Collateralization. Requiring borrowers to provide assets as collateral, providing a cushion in case of default. Risk mitigation techniques. Utilizing credit default swaps, CDs, or credit insurance to transfer credit risk to third parties. Operational risk involves potential losses resulting from inadequate or failed internal processes, systems, human errors, or external events. This risk category covers a wide range of factors, including technology failures, fraud, legal and regulatory compliance issues, or natural disasters. Key strategies to manage operational risk include risk identification. Conducting comprehensive risk assessments and identifying potential vulnerabilities across operational processes. Risk controls and mitigation. Implementing robust internal controls, segregation of duties, and establishing disaster recovery plans to minimize the impact of operational disruptions. Training and awareness. Educating employees about operational risks, promoting a risk-aware culture, and providing training to enhance skills and awareness. Business continuity planning. Developing strategies to ensure the organization can continue operations during disruptions, including backup systems, alternative locations, and communication protocols. Identifying, assessing, and managing financial risks are fundamental aspects of risk management within the finance industry. Market risk, credit risk, and operational risk are prominent categories that demand careful attention from financial institutions. By employing appropriate risk management strategies, organizations can minimize the negative impact of potential risks, enhance decision-making processes, and protect themselves from unforeseen circumstances. Successful risk management practices not only ensure the stability and resilience of financial institutions but also contribute to the overall health and trust in the global financial system. Here are some examples that illustrate the application of risk management techniques to different types of financial risks. Portfolio diversification. An investment firm diversifies its portfolio by allocating funds across various asset classes, such as stocks, bonds, and commodities. By spreading investments, the firm reduces the risk of significant losses from adverse movements in a single market. Hedging. A multinational corporation uses currency futures contracts to hedge against exchange rate fluctuations. By locking in a specific exchange rate, the company protects itself from potential losses when converting foreign currencies. Stress testing. A bank performs stress tests on its loan portfolio to assess the impact of severe economic downturns. By simulating scenarios like a recession or a significant market decline, the bank can identify potential vulnerabilities and adjust its risk management strategies accordingly. Credit assessment. A lending institution analyzes the creditworthiness of individual borrowers before approving loans. By reviewing factors such as credit history, income stability, and debt-to-income ratios, the institution determines the borrower's ability to repay the loan and sets appropriate lending terms. Risk rating. A credit rating agency assigns credit ratings to corporate bonds based on the issuer's creditworthiness. These ratings provide investors with an assessment of the risk associated with the bond and help them make informed investment decisions. Collateralization. A bank requires borrowers to provide collateral, such as real estate or valuable assets, when granting loans. In the event of default, the bank can seize and sell the collateral to recover a portion or all of the outstanding loan amount. Operational risk. An insurance company conducts risk assessments across its operational processes to identify potential weaknesses. This includes evaluating IT systems, internal controls, and employee procedures to proactively address vulnerabilities. Risk controls and mitigation. A financial institution implements strict internal controls, such as segregation of duties and dual authorization, to prevent fraud and unauthorized activities. Regular audits and monitoring mechanisms are also in place to detect any potential operational failures. Business continuity planning. A stock exchange develops a comprehensive business continuity plan that outlines procedures for handling disruptions, such as natural disasters or system failures. This includes backup systems, alternative trading locations, and communication protocols to ensure continuous market operations. These examples demonstrate how risk management strategies are applied to mitigate specific financial risks, providing organizations with a proactive approach to managing potential losses and maintaining stability in the face of uncertainties. Thanks for watching.